Hey traders, in this video I'm going to show you two ways to use a spread when options trading. So if you're new to spread trading, or if you've heard the term but don't really get what they are, I hope this video will help you out. The first example will be Nike. Now Nike reports earnings this week, so therefore option prices will be very high as implied volatility, which is right down here below, is pretty high. Now why is that? Well, the market makers, the guys and girls controlling the option prices, are going to make the options very expensive because there's uncertainty. There's an unknown of what Nike will do on earnings. So before earnings, volatility and option prices will be high, and then after earnings, option prices will be low because implied volatility gets crushed, as we now know Nike's earnings results. So I'm going to go in Nike with a slightly bullish trade idea, and the reason for that is Under Armour and Dick's Sporting Goods have both been seeing call buying. Nike today has seen some call buying as well, and the chart is neutral to bullish over the 8-day, over the 20-day moving average, right at the 200-day moving average. And if you look at the prior history of Nike, it's kind of sold off the past 2 quarters, so I think they'll have a little upbeat. The first thing I want to look at is the implied move, which is about $5.67. So I'm going to use that implied move when I consider a trade. So we can see implied volatility is high up here, about 65%. Again, this is why we want to use spreads when trading, because let's say I go and buy the outright June 25th 133 strike call. That's going to cost me about $300 and $335 or $3.35 per contract. That's a lot. Now, what happens if Nike goes down on earnings and these calls expire in 2 days? Those calls, let's say Nike goes down, could go to zero. So that would be losing $335 in a day or two, right? I don't want to do that. This is where spreads come in. I'm going to look to sell a put, bull put credit spread. We never want to sell naked puts. Never sell naked options. That's very risky. So I'm going to look to sell the 130 puts. Now I can do that here for about $1.52. So therefore, I collect $152 per contract. Well, I'm going to go ahead and buy these 129 puts for protection. So again, we don't want to sell naked options. So let's go ahead and buy these right here. Therefore, I want to sell on the bid, buy on the ask. You can either hold control down while you do it, or you could go to spread and go to vertical. Vertical is basically the same thing as the same thing as a bull put credit spread. Some people call it vertical spreads, like here on TD Ameritrade, it's called a vertical. So you can see here, I sold the 130, 129 bull put credit spread, and it will actually be labeled sell Nike 130, 129 spread for about $33. Now, why I like this trade is this. Let's go to and actually analyze it. Go to a risk profile. There we go. Nike. There you go. So we go here on Nike. There we go. And this trade, I am risking $67 to make $33. But here's the good part. As long as Nike is above 130 this week or higher, I'm good. I make money. I collect that full $33. So Nike can even go down. Where's Nike trading at right now? 133.40. It can even go down $3.40, and I make my maximum gain. I can't lose any less than the price of the spread. So I got $33. The price of the spread, $1 wide, so $1 minus 33, $67. That's my max loss, is $67. That's it. My max gain is capped at $33. So this trade has about, according to TD Ameritrade Thinkorswim, about an 84% chance of making money. That's really, really good. And Nike can even go lower, about $3.39, and I make money. Now, what happens if Nike shoots up to 140 or so? Well, I still collect my $33. When I do a bull put credit spread, I'm collecting a credit. That money goes in my account. I'm good. When I'm buying a spread, I'm doing a debit. So let's actually look at buying a spread here in Roku. And the reason why I pick Roku is Roku is a very expensive stock. Not only does it have implied volatility, usually year-round, because it's It's a high mover. It's not uncommon to see Roku move 3, 4, 5% a day. Like today, it's up nearly 5%. But Roku, even if I go to the options, and let's even look at the weekly options, these options are very, very expensive. The weekly 420 calls are $10.50, meaning if I want to buy one contract, I'm risking $1,000, $1,050. That's a lot of money to buy one contract. Now, let's say I want to have exposure to Roku on the long side. I think this move is going to continue, but I don't want to pay $1,000+ just for one contract. That's a lot. So what I can do is this. I can go ahead and buy these 420 calls, so I'll buy them on the ask. And again, instead of paying that full amount, I could go ahead and sell call options against it. So let's say I want to sell these 430 calls. So I'll go to the bid and sell them here. So now I'm only paying about $4 or $400 for the Roku 420, 430 bull call debit spread. So I'm buying these as a debit. Now what this means is since I bought the 420 calls and I'm selling the 430 calls, my max profit potential is if Roku is at 430 or above by June 25th expiration. If so, my max gain, and we can even see it here, will be the price of the spread minus the debit I paid. So it's a $10 spread minus $4. So that would be $600 is my max profit. Now, let's say I wake up tomorrow and Roku is down $20. Maybe it gets a downgrade or the market sells off. The max that I can lose on this spread will be the price that I paid for this call spread, which would be $4 or $400. So this is a really good way to not really pay so much money for buying outright calls by spreading out the trade. And my break even on this would be $420 plus the $4 I pay. So really $424, which is pretty much right where the price of Roku is now. So I'm basically controlling, I'm basically putting a stock replacement bull call spread on for Roku. Now, and this will move as the stock moves higher here in Roku. Now, let's say I want even a cheaper spread here in Roku. Let's say I think, you know what? I think Roku's going to go up $20 tomorrow. And I don't want to buy, again, expensive options. So what I can do is buy something like the 430, 440 bull call spread. And I can do that for very cheap, about $2.50. Now, on this spread, is it a little bit more risky? Oh, you bet. But look here. My risk versus reward, if Roku is over 440 by this week expiration, is I'm risking $250 to potentially make $750. Now, where's my break even? Well, I bought the 430 calls. I paid $250 debit for the spread, so that would be $432.5 is my break even on this trade. So, as you can see, the further out the money you go with your call spreads, the cheaper you're going to pay, but the less probability you have. But this is a fantastic way to use call debit spreads to get long stocks that maybe have expensive options, or maybe they're just, too volatile, and selling bull put credit spreads ahead of names, ahead of earnings to get that credit, collect that premium when you don't know exactly where the stock's going to go on earnings, but you have a pretty big window. Even if the stock stays flat or drops a little bit, you can make money.